Well, all right, Alexio. I just want to say thank you for coming in to the podcast room. You're our first episode, and I invited you in because I think that you could provide a lot of value to our listeners as far as buying apartments, selling apartments, acquisitions. So, the first question I had for you was just, can you tell us a little bit about your story and how you got in the game? And then we'll dive into like your first deal and that type of stuff. But I just want to know like what got you into real estate.
Oh, sure. So I got into real estate right after. So I went to college in UC Santa Cruz, graduated in 2015, and I just kind of came back not knowing really what I wanted to do. I got a degree in business management economics, and that's kind of a broad degree. You can go into a lot of places, sales or even just finance. But my dad owned apartment buildings, and he had actually just done a deal in North County, San Diego, and Vista.
Nice.
And he was like, "Hey, well, if you want, you can hang out with this guy's name was Dave Cameron. He worked at South Coast. He helped me buy this thing, and he's a really sharp shooter, and you can just see if you're into apartments." And I said, "Hey, why not? Like, I think like anything in life, when you're not sure what you're gonna do, you just start trying stuff.
Sure. Yep.
And then you figure out if it's for you or if it's not." So I, hung out with this guy a little bit. We went to some of his big deals in San Diego. I saw him like talking to tenants and maneuvering with the laws in place or some tenants not paying rent. And then we met with an owner, and he was selling them on a property that, so I kind of shadowed him for a whole day. And I thought, hey, this is pretty cool. This guy seems cool. Why don't I spend a couple more months doing this? So I shadowed him for a while and decided, hey, I'm gonna get my real estate license. So I was helping him on the back end, and then I got my license. So I started making calls, and funny enough, he actually fell in love with a girl in Phoenix, Arizona, and so he actually moved out. So my mentor was gone, but luckily South Coast. One of the reasons I really liked it there was a lot of experienced guys who were willing to share their knowledge. So I kind of just piggybacked with the next guy in the shop, who was the owner of the company, Kevin Hemstreet, and he kind of took me under his wing and kept training me and helping me on listing appointments and whatnot. But yeah, seeing the value in this field, the reason why I decided, hey, real estate's cool, is because I could see, one, people were making good money after a couple years. Everybody I talked to said it takes a couple years. You're going to be struggling for a while, but once you get your client base and you get your feet under you, you'll be doing well and you make your own schedule. So that was one reason why. And then the second reason is I could see the light at the end of the tunnel, which is kind of like on your side of the table, where you own more property, and then more and more property that you own, the more and more cash flow you're generating, and that's your retirement. Once you're making money while you're sleeping, and enough money to finance all of your dreams and trips, travels, charity, business ideas.
Yep.
That's freedom. So
freedom.
I said, well, all of these guys that are selling these properties, they also own property, and I'm going to be seeing the best deals in town like before anybody else. So this sounds like a great just medley of everything I'm looking for.
Yeah.
And so yeah, I kept stuck with it. Now it's 2023, 8 years in, sold, 150 million. Actually,
it's amazing.
I'm like undercutting it. That's like a couple of years ago. I'm like 300 million.
Let's go. Let's go.
No,
that's year, big, man. That's awesome.
Last year we did 60 million. The year before that we did 80 million. And then, years running up to that, I did less. But over time, your clients kind of build and compound, and obviously values have gone up too. So all of that working hand in hand, doing a lot of 1031 exchanges, selling one property, buying another property. You start piggybacking and building on each other.
Yeah.
So,
nice.
It's been good. I'm happy doing this, and working with guys like you, selling some San Diego State stuff. But
let's go. How many have you sold at San Diego State? Quite a few, right? I think I know the answer. I'll guess.
Yes.
I think 30.
30
or more.
We're at 29.
Wow.
But I'm trying to sell another property right now. I'm actually trying to put it in contract today. So
nice. One of mine?
Maybe we'll be. Hey, I want to. I got to get an updated list from you.
Yeah.
I'm working with a buyer on one of Matt's deals
right
now. So we're trying to get an offer together.
So that must have been a game changer for your business to be able to like sell these, right? Because like it's a whole new stream of.
It was,
like,
it was really weird because we do apartment buildings, and then we're working with Matt and Luke initially, and we sold them an apartment building, and they were saying, hey, well, we want to sell these so we can exchange out of them. And I was like, we really only do apartments. I'll take a look at them. And I was like, oh, these student rentals are just straight apartment deals. They're just
cash flow.
People buy these based on the return.
Yeah.
At least on the level that they were buying. On your end,
The stabilized ones.
On your end, you're looking for deals you can buy. There's like maybe a house that someone's living in. You can add bedrooms and then convert the garage into an ADU. But the buyers of those final products are, typically someone who maybe more mom and pop, doesn't really want to do all that work dealing with contractors and just wants to park their money and make, start this steady return.
5-6% stabilized, maybe a doctor, chiropractor, engineer.
Yeah, exactly.
Just want to park their money and not think about it.
Exactly.
Turnkey management.
So we kind of figured out that was the exact client MO, and then we sold one, and we sold a couple more. You guys started seeing, we sold some, we were like the trend-setting comps. They had never sold for like over $1 million, and then they like went for like $1.3 million, $1.4 million. We were generating all the comps. I remember it was crazy because appraisers we were at a deal. I'm like, this deal needs to appraise for this value. And like, here's the best comp is like 100,000 under. And they're like, I can't do it. So then the buyer would have to come up with an additional 100,000. And then on the next deal, we would use that one as the comp. And then we get it another 100,000 higher. And then the buyer would have to come up with another 100,000 until we ended up at, $1.7 million was like the comp price. And that's where we have comps now. So we don't have problems with appraisals anymore, but we had to work our way up to that.
Do you think we will in the future if values fall a little bit? What are your thoughts on that? And like interest rates and recession?
For the time being, I haven't seen any like significant drop in prices. I've seen the build that we've had like come to like a halt. Yeah. And then in some areas we're seeing a little bit of a downward trend, but like we have the appraisals are active for about six months where they can use the same comps, 6 months to a year. Usually they try to stay within 6 months though. And in the last 6 months, like if I was going to close a deal tomorrow or like 30 days from now, they would still pull comps from November.
Nice. Okay.
Or October. So like we wouldn't have an issue, and because we have comps in October, November that were in that higher mid-million range. Yep. But over time, if the trends continue heading downward, then they're going to see the comps go down, and then you're not going to, but realistically, I don't think we'll have appraisal gaps like we did before.
Got it.
That was really on the way up.
That was on the way up. Yeah. When we were buying single-family homes for 700, 800, adding the ADUs, that was the problem, is these appraisers didn't know how to appraise with the ADUs. But once they start doing it based on rental income and seeing the comps, it all just... Yeah. What is the quote? A rising ship rises all tides or something like that?
Rising tides lift all ships.
Yeah, something like that. That's what it felt like, just one deal by deal.
Yeah, I felt like every single deal I would show up with all the comps. I would do all of the appraisers work for them, and I would try to like educate the appraisers. Yeah. Single family, even 2 to 4 units, they look literally only at comps. Yep. They don't look at the cap rate or the return and then like back out of on pricing from there like you would underwrite stocks or anything like that. Yeah. Literally like, what did this one trade for? That's what it's worth on a price per square foot basis, or what the total value was. But I was trying to educate them to use this other method, but they're like, we can't use that. And it was a failing battle, but I think it helped to push the value up each time.
Got it. Okay.
Eventually though, we had the comps, so it wasn't an issue anymore.
Now we're good.
I remember those days, though. I was so frustrated.
Stressful.
Dealing with the appraisers. I think even on Mary Lane or a couple of years, we had issues, and they had to come up with a gap, or we had to negotiate. You had to eat
price, maybe like a 30,000 reduction. Yeah. Back before this, we were still just stressing on like, before the ADUs, we had problems with comps. We were just trying to get like an 800 value, or we've always had cash out refinancing.
It's so funny seeing some of your like CRS data reports, because there'll be like 10 refis on the same property within like 3 years.
We were just pulling all our money out and then reinvesting it. That's how we built the empire so fast. So I got a question. I was on a call yesterday with someone who watched a podcast of mine, and he was curious, like, hey, like how can I just like break through? And he was curious if he should go through like start buying single family homes or jumping straight into multifamily. What's your opinion on that? Obviously, I know there's pros and cons to both, but what would you advise to him? He was a junior college student at SDSU, and he wants to get into multifamily or single family.
Well, I would say first, like what your plan is, if you're going to be 100% involved in flipping and managing, kind of like you and what you kind of transitioned over to after because you had that iPhone business before.
Yep.
But then you went all in. And I mean, the fastest way to make money in real estate is to buy like value add or fixer flippers or something that you can convert the garage into an ADU or build multiple ADUs in the backyard.
Yep.
But to do that, you need access to capital. So if you have the capital, I would say like, work with someone like Chris or myself, and we could show you the way to do that. We'd show you actual deal, go over actual numbers, see what the actual spread would be. Say, hey, you buy a place for $1 million, you're going to build an ADU for $300,000, and then once you're done with that ADU and renting it, 6 months to a year later, you'll sell it for $1.6 million or $1.7 million. So you'll make that $300,000 spread. That's like the fastest way to make that, but a lot of people invest for cash flow. So they'll buy, the best cash flow is probably on multifamily deals or San Diego State, flipped houses that already have the ADU. So if you're just like the kind of person who has like $1 million in the bank and you're like, inflation's eating it up at like 8% right now, I need to put this money to work somewhere so at least it can keep up with inflation or do better. In my experience, when you look at apartments, and a lot of people don't know this, but like if you look at multifamily investing, the real return is somewhere upwards of 15 to 20% conservatively. And that's if you're taking, you might only be making like 2 to 5% on the cash flow, but
appreciation,
you have like
depreciation,
all this stuff underneath the like surface, which is the depreciation, right off, which saves you a lot of money on taxes, the appreciation, which lately has been like insane. We've seen appreciation of like 30% over the last 2 years. But even if you're conservative with 2% appreciation per year and you're leveraged, you're doing really well. So you have the depreciation, appreciation, and then the big one is principal pay down on the loan, which is like a savings account that you can't touch, but you're paying off like what you owe to the bank over time, over a 30-year fixed mortgage. And when you take all of those appreciation, depreciation, and principal pay down plus the cash flow, you can get between 15 to 20% returns on real estate, which is much better than stocks.
Crypto,
well, yeah,
401ks.
Most investments. And then the beauty is, you go and sell that later a lot of time, or say you do make a gain on the appreciation. Usually you sell a stock, it went up from $100 to $200. You're going to pay $100 of gain.
Yep.
Taxes. So they're going to tax you, and you're going to pay like $50 to the government, $45 to the government. But with real estate, as you know, you can do a 1031 exchange. So
tax free.
You sell it.
What is a 1031 exchange for maybe some listeners don't know?
Yeah, no, the 1031 tax deferred exchange is if you sell investment property, you can reinvest into a like kind asset. So you sell a house or a duplex or a 5-unit building that you're using for income. You sell it the day you close escrow. You have 45 days to identify another property that you're going to buy. You can identify up to 3, or you can use, there's another rule where you can identify more than 3. So you have 45 days to identify, and then you have 180 days to close. And if you abide by those rules and you close on the property within 180 days of selling your downlake property, that gain that you would have paid, say you bought a house for $1 million, you sell it for $2 million, you owe the government like $450,000 in gain if you did that and just took the money. They'll just like let you reinvest that in another income producing asset tax free.
So bigger and better.
Bigger, better. It's a good way to scale.
Grow the cash flow.
Right.
Nice.
And yeah, usually you'll want to hold the place for at least a year before you do that. But
because of is there like a short-term capital gains and a long-term? If it's under 1 year, it's
right. Well, if it's under a year, typically that's a rule. There's a short-term capital gain. There have been people who've gotten away doing 1031 exchanges. It's all about intention.
Yep.
And so if you had the intent of holding it longer than a year, and then an offer came out of the blue that you just couldn't refuse, then I had to take it. But I was intending to hold it for more than a year.
Got it. So it's intent.
That's kind of a gray area, and typically the rule with, you talk to 1031 guys, they say if you hold it for at least one tax year or you sell it within a different tax year, then you don't have these complications with the
Got
IRS,
it.
because last thing you want to do is get audited. It's like a whole fight. And,
Okay.
You know,
Yeah.
but at the end of the day, trying to save you money, you don't want to be paying extra gains. I mean, $450,000 and $1 million, that's a lot.
450
of money to
buys you
consider.
$2 million worth of assets, right?
Yeah,
So it's,
exactly. And like, you know, it's like leverage. You can
Yep.
grow bigger, better, faster, stronger if you save more of that money in your pocket.
Absolutely. Okay. Okay. So the next question I had was ChatGPT. It's a hot topic right now, right?
Is it GTP?
Is it GBT? GPT?
GTP.
Something like that.
ChatGTP, I think.
Yeah.
You would know.
So here, I gotta figure this out real quick. I think it's Chat GPT. Yeah, Chat GPT.
Okay.
So, you know, I'm hearing a lot about it, the pros, the cons. Have you started using it? And are you
I used it. I mean, I've looked at it. Have you played with it?
a little bit? I've asked some basic questions and I got some answers. Like I was like, what's the cap rate in Las Vegas? And it said like 8%. But I think it's because it takes data from 2021
Yeah.
onward. So,
I think with like the current events and current news data, it's not great.
okay.
Because it, like you said, I think it's 2020 and older, or 2021 and older.
Yeah.
2 years old data. So like if you ask the cap rate of Vegas, it would tell you like 2 years ago what it was.
Got it.
But I thought it was really cool. I actually used it for I was like, I got to play with this thing. It's like all the buzzword on the news. I put in, write me like a blurb about San Diego State school and neighborhood. So that I can use it in the listing that I'm putting out today. Because
Yeah.
on the listing, you know, you have to put together the marketing portfolio, and usually I'll take 20 minutes and just like come up with something crafty about like the neighborhood surrounding a house. But I said, ChatGPT, do this for me. And it actually, and I said include like walking distance to SDSU and, you know, pre-lease for 2022 and 2023. Include these things and add, you know, more about just students enjoying this neighborhood. And then it created a great blurb that was actually pretty long. And I said, hey, shorten that. And then it made it more condensed.
Like instantly.
Like within 2 seconds. So like
That's
something
crazy.
I actually have a intern who's been working with me for about a year now. And I had him doing all our just solds and even creating market blurbs and things like that. But now I'm like, hey, I'm going to have you do other things because this is doing it faster than you could. And I'm checking your work anyway. I'm going to check this. And I have to tweak it at the end anyway.
Yeah.
But I mean, it's like one less thing that I have to put on his plate that I can just put on this AI's plate.
Yep.
And frankly, it makes me a little nervous about like how much this is going to disrupt the industry and, you know, all these jobs. I mean,
Copywriting.
they say students can just say, hey, write this. I actually had it. I heard that they said students can have it write essays for them. So I went in and said, write a 5-paragraph essay about like ancient civilizations. I just watched this like Netflix documentary on like ancient civilizations. I said, mention the caves in Turkey. And then it wrote a 5-paragraph essay in like 10 seconds about this whole thing. And I was like, this is exactly what like I was asking it to do.
Yeah.
And yeah, it's scary.
It's going to disrupt a lot of industries for sure.
I wonder if like there's going to be a difference in quality. I mean, I'm sure that there's probably going to be a difference in quality, but I wonder at some point it's probably going to be just as good as if you hired like a copywriter. Like you know, a very creative person to write like that catchy copyright that you want for something.
So for short form videos, when we're scripting for Instagram or Reels and whatnot, I mean, it's like basically becomes a new employee you can hire to basically write these scripts, and you just read it on a teleprompter. And it's like,
I would be a little embarrassed though if like
something
it made some like weird assumption that like you get double checked and you'd be like you read that on a teleprompter live and you're like, I didn't mean so.
Yeah. That's funny, man.
Yeah, but it's really cool, and I hope that they put a fail-safe in there so it doesn't you know, turn evil and go Terminator on us. But I think there's a lot of uses for it.
Yep, absolutely. Okay. So obviously, you know, I'm doing like Luna Capital. I want to get into raising money, doing bigger deals, blah, blah, blah. What advice would you have for me as I go and try and like acquire different properties? Like if I wanted to build an acquisitions team, like what do you think that would look like?
So I think I can give you the perspective from a broker, who's deciding which horse to run with if you have a deal with, or if this buyer is going to pull through on a deal. I think on that front, and I have worked with syndicators before. I mean, I've worked with you on many deals, and you were syndicating a lot of projects up until this point. Now I think I heard you say recently that you want to start moving towards like a fund style.
Yeah, like in San Diego State, it was more friends and family. My money was equal. There was no like syndication LP-GP split. So my money's been equal with my partners is what I'm saying. But I am considering, a fund model, syndication model is just something to, as I build an audience and a brand, I think I'd be able to scale. So I'd prefer to do bigger deals.
Right.
Yeah. But yeah, a fund is something.
I think it's ideal. I think it's every syndicator's like someone. I mean, obviously you found success raising money, friends and family. I'm sure. I think you've done some deals where you found success too. Raising money on apartments, bigger scale, and you see the value in doing bigger scale.
Yeah.
So I think everybody who's doing what you're doing eventually wants to get to the fund status, kind of like Grant Cardone, where people are just saying, "Hey, I trust you. I want you to here's $1 million when you're ready, when you find the right deal.
Yeah.
Go for it."
How do you get there? You think just track record and deals?
I mean, I think everybody tries to jump there a little too quick.
I think so too.
It's frankly, like, how many people are just going around saying, "Here's $1 million, do what you like. I trust you, to do what you want with it." Well, essentially, I think with the fund style, you're getting a preferred return on the $1 million.
Like a 6%, the second
they put
it
it in your account.
Yeah.
So that's also on you too. You're like, I can't just have this money sitting.
You got to deploy it. Take the money and deploy. Yeah.
So you don't want to have a fund that's just too big sitting there in the bank, which is powerful because you can get good deals.
Good deals, all cash, and then refinance later. And
exactly.
Yeah.
So I think that you kind of have to decide on what type of deals you're going to go after too. If it's going to be cash flow plays that are high cash flow, and then you're going to make a spread over the what you owe the investors, or if you're going to go for like fix and flip deals where you're going to make higher yield returns. Investors get their 6% pref, and then like maybe a percentage of the upside on the deal as well. But the most successful people, and the way I think is like good business to do these funds, is that the syndicator, the fund manager, doesn't get paid until all the investors get paid.
Yeah.
So that you're highly incentivized. I mean, if I was a person about to give you money, I'd say, "Oh, you're not getting paid unless I get paid." Like that you're incentivized to make this freaking thing work.
Yep.
Whereas we work with I've seen fund managers before who get paid like on the acquisition, and they get really like a big acquisition fee.
Asset management.
3%. Asset management fee every
disposition
single month.
fee. Yeah.
And like if there's an asset management fee and you're collecting that every month, then like you're not really incentivized to get the project flipped and turned over quickly because you're collecting the fee longer.
Interesting.
So I think it's trying to align like your fee structure with the interest of your investors.
Got it.
And in that example with that, one fund that was collecting those huge fees all throughout, they just never ended up flipping or finishing out any of the projects. It was supposed to be a 1 year deal, turned into a 2 year, 3 year, 4 year deal. And then eventually the deals went under. In fact, that's like one of the ones that I was involved in.
Right here on Broadway?
Right here on Broadway. I'm actually I'm showing up in court on Monday to fight.
Can we talk about it?
To fight that case. I mean, I can just tell you about my experience with that one in general. Maybe you can, because it was a syndicator.
Got it.
Maybe you can learn from his mistakes.
Yeah.
And make sure you don't.
Yeah.
Follow in those footsteps. So I was. This was about 2-3 years into my real estate career at South Coast.
2017.
Yeah, it was 2017,
okay.
I think. So I was selling a couple deals to a guy who was a syndicator, and we kind of became friends. He was doing a lot of deals with me too, and I was, building my book of business. And if I did more deals with him each year than I was doing with anybody else, so I was like nurturing that relationship. I wanted to keep that going. And I was also really busy. I was, my business was really starting to pick up, and my dad approached me and said, "Hey, we have some money from a refinance. Do you want to deploy this somewhere?" And I said, I am so slammed right now. I don't have the time or wherewithal to try to learn how to do, flipping or any of that too. I'm just like keeping my nose to the ground, trying to master and get this like real estate, commissions and brokerage on autopilot. And I think that was the right decision too, because if you try to do too much at once, like you can just do a really crappy job at everything. So I wanted to master one thing before I moved to the next. However, I said, hey, well, there's this one guy, he's a syndicator, and he would be open to like taking additional funds. Right now he's got a couple projects, and as far as I know, he's been doing a good job. So we ended up deploying about like 500,000 with him over the course of like 3 projects. So that one, it was like project specific, kind of like less like a fund and more like a syndication. So it's like, hey, we were raising this much capital for this deal A, deal B, and deal C. And we said, okay, we want to allocate this much to deal C, deal B, and deal A. And these are the timelines we're going to get our return back in 2 years. And I was like, this is great, because 2 years from now, I'll have mastered the real estate side on the brokerage, and I'll probably have more breathing room to actually take back this, money that we're invested with him. And the horizon's 2 years from now, I'll get the money back, and then I can deploy it and do exactly what he's doing myself. So it'll be a nice place to park the money for 2 years, essentially what I was thinking.
Yeah, makes sense.
But turns out this guy was short raising money on a lot of properties, and was kind of like mixing the fund together, commingling.
Yeah.
All kind of like, books were horrible. It was hard to get like taxes every year. That was like the first red flag, trying to get our K1s. And I think that's like the biggest thing that makes investors nervous, is if you're not having good communication with them.
Yeah.
Like they ask you, hey, how's the like, even if you're just giving like quarterly updates or bi-monthly updates on how a specific project is doing, just like a quick like 4-line
email blast. Yeah, a quick little email blast
to those specific investors. It lets them know that someone's driving the ship.
Yeah.
But if you like, we were going like 6 months with no updates, or like the same update would be like, oh, we're still waiting on the city for this thing, which unfortunately is a legitimate update, because the city can stall you for years.
Yep.
But we weren't making any progress, and like, we're supposed to have the money back in 2, or looked like we're supposed to have the money back 2 years, but like a year in, I'm like, this isn't going to get done for like 3-4 years.
Yeah.
So like, I need to start riding your ass so that we can start seeing some real progress. But it turns out, he had an asset management fee and these other fees that he was making, and the acquisition fees. So he was less focused on managing our projects and pushing them along than he was on finding more deals and putting money together for more deals, because he'd get paid an acquisition fee when he would do that. So that's where he was making the most of his money. So his interests weren't aligned with the investors.
Yeah.
In the end, he was like just getting squeezed left and right, because he was in over his head. And you actually, I think, have experience with this on like a recent deal, but he went on a really big deal. I think it was like a Marston building downtown. Was raising money on it for like 6 months. Ended up coming in short. It was supposed to be like 2 months. Came in short 2 months. Released money not refundable. Got himself a month. Released money not refundable again. Got himself another month.
Yeah.
But then it came to a point where he couldn't get any. Like, he ran out of investors. And
that wasn't his money. It was investor money.
And it was his investors' money. And so those
rough.
deals went away. Turns out though that he actually had sold one of the properties that we were invested in.
No
without
way.
us knowing, and then took that money and invested it in this other deal to try to save the bigger one, so that he can make an act fee on that. And then
that's just bad business.
Oh, horrible business. The guy is a total, like, doing this kind of stuff is like total scammer. Like, that's obvious no. And then on top of all that, we would tour that building like 3 times after he had sold it without telling us. And like, he gave us like tours of the building, acting like we still owned it. Like, it was total scam.
No,
anyway,
I see why you're going to court.
Long story short, he had done this before in New York, unbeknownst to us. And he actually went to jail. Like, one day he just disappeared, and I was like freaking out, because, had a bunch of our money tied up with him. But disappeared, and he was in jail in New York, and now he's facing like 25 years in California too. He lost somewhere upwards of like $1.5 million in investor funds, or maybe more than that.
Wow. Okay, so for the people listening, that's what not to do.
Right. Yeah. So I mean, take that experience and just, I think the big things to learn from my bad experience with syndicators is this: the best thing you can do as a syndicator or fund manager is to maintain good communication. And then also abide by the common sense rules of business, which are like, don't commingle funds. Like, every project should be siloed and like its own thing. So if this one over here doesn't do well, that doesn't mean anything about this one. You should be giving the same amount of attention to this one. Should be meeting its deadlines. And then also under promise, over deliver. I mean, you should be very conservative on like the time frames. I think it's hard for fund managers, because you want to like make it the sweetest piece of bait to try to raise the money. But I think it's just about checking yourself and being realistic on like what's actually possible. Because if you over deliver on your timelines, like shorter time frames and better pricing, I guarantee that money is going to come back.
It's gonna come back.
2-3 fold.
Yep.
Like it's very rare to find people who do that kind of
Good work.
Good work.
Yeah. Nice.
So.
Those are all really good tips. I appreciate that. So what are your thoughts on different markets? I know you primarily deal with California, right? That's where you do all your deals. What are your thoughts on different markets? And what are your thoughts on the California market, evictions, tenants? Some of that stuff is kind of scaring me from investing here these days, or from investing in deals these days here. But yeah, just want your thoughts on that.
Yeah, I haven't done a lot of research in other markets. I do own a building with partners in Tucson.
Apartment building?
Yeah, it's an apartment building with two of the owners of South Coast. We actually own like 50% of that one. I think it's like a 60-unit project.
Nice. How much was it?
I don't have all the numbers in
Okay.
front of me, but I think we got it for like around $5 million.
Nice.
They're a lot cheaper price per door than we're looking at here.
Yeah.
But the only reason that we were even open to that is that one of our partners, Joe, owns and manages, well, he owns another like 200 units there and manages probably upwards of 600. So we have like a footprint
Got it.
with one of our partners who's someone we trust. And
Yeah.
he's actually kind of the manager of this, like our little syndication that we have.
Mm-hmm.
And he's just done a really good job for us, under promised and over delivered. So we're like, I'm not even really that concerned
Yeah.
with him.
Do you guys have units up in Sacramento too? I thought that the South Coast.
So
had
we
some-
did. We do have another office in Sacramento,
Oh, okay.
which was, and honestly, I did a lot of deals up there early in my career when Sacramento returns were like 7 caps and down here was like 5 caps. But surprisingly enough, it turned into like 5 caps
in Sacramento.
in Sacramento, and it's like, why
Interesting.
would I buy Sacramento when I can buy those returns in San Diego? Like
Yeah.
Sacramento's flooded right now with
Really?
all the rains. Like,
Oh wow, that's my
and it's-
hometown.
and it's just like flat. I mean, so
Yeah.
you're from there.
Yeah, I'm
so-
from Sacramento.
So what do you think about the difference in quality of life? In both of
Yeah,
these
I mean,
markets?
I'm down here for a reason. SoCal's where it's at.
Yeah.
Sacramento, I do like the price per unit, but I mean, if you're looking at cap rates, yeah, I'd rather be buying in San Diego for appreciation, right?
Right. Well, I think that there's the appreciation, but there's also like just the overall return. And Sacramento itself is under Sac City rent control right now, which happened over the during COVID.
Oh wow.
Where they made it so it's like the strictest rent control in California now. So
Well, good to know.
Long story short, I bought initially with this group like a 23 unit in Sac. We exchanged that in 2018 into like 18 unit actually, but it was in like downtown Sac, so it was like a much better location. We actually were making a good return on it. And then from there, we exchanged that into this property in Tucson. And we also have another property in Northern California.
Nice.
Near Chico.
Okay.
So, but yeah, answer your question about these different markets. I personally like stuff that you asked me about the 2 ways for a college student to make money.
Mhm.
Maybe that's the cash flow method, or if you want to do the value add method. I'm big on value add right now because I'm at a point in my life where I can devote a lot of time and energy to managing contractors.
You're on the come up. Like you don't mind putting in that time and
I'm
effort,
not-
right?
Yeah, I'm not
Build that
retired.
equity, yeah.
I feel like once you're retired, like people in my dad's position, he's like, I don't want the headaches. I've got like enough cash flow now.
Yeah, you go buy a triple net or something,
I don't want
and
to go chase a contractor around. I just
Yeah.
want to park the money and let it work for me.
yeah.
That's like one stage I'll be at in life, but right now I'm at the stage where I want to build up the nest egg.
So you want to be able to see it, touch the asset, so it makes
I
sense.
can't do that if it's in Tucson. I
Yeah.
can't do that if it's in Florida.
Yep.
I mean, there's these good markets that have all these, don't have rent control or don't have tenant,
Yeah.
like crazy tenant protections that are out of balance, like we have here in California. But there's pros there, but I don't want to leave. I don't want to leave San Diego. That's like one thing keeping me here, and then 2, I don't want to be managing. Like I have a couple properties in Vista, and I'm flipping and doing ADUs like you do.
Those are kind of like the value add plays where you're building
Yeah,
equity just
yeah.
by doing the work.
Yeah, and then
Yeah.
I'll like even throw a HELOC on it or refi, and then I'll use that money, and I've
Yeah.
got that money sitting and waiting to deploy when I find the next value add opportunity. And I can only do that already Vista is like 45 minutes from here. It's tough to chase.
It's already tough enough to
check
do it
that
here.
one.
Yeah.
I can only check it like twice a week, versus if it was in PB or like
Yeah.
Claremont or anywhere around downtown, I could be there in 10 minutes from my house versus 45. It makes that little difference in time makes a difference.
Yeah, absolutely. That totally makes sense, and I'm with you with that.
Well, like going to like Sacramento or like all these, anytime you have to hop on a plane, that's like adding 3 hours to it. Like next question,
Yeah,
like
yep.
it's too much. I'm not trying to get on a plane like 3 times a week.
Yeah, unless it's an absolute steal, maybe you would.
Maybe if I'm looking at making a couple million on a project.
$50,000 a unit out in Vegas, 100 units.
I saw you walking that. Are you eyeing some properties in Vegas?
You know, I have some connections out there. I'm in Grant Cardone's real estate club, so I have people in different cities who are looking at different deals. I'm actually flying to Vegas tomorrow to look at some apartment deals.
Nice.
And I think it's good to just see different markets. Doesn't mean I'll invest there, but if I have a good operator out there, that kind of solves that question, you know, that issue you would have.
Right.
Like if
you
I have
trusted boots on the ground.
Yeah, who was taught the same way to invest, you know, and treat, you know, basically manage the asset how I would, then it could work. But
if you have the scale, it makes more sense too. If you're trying to do like a 4-unit flip, then like that's
the headache's not working.
There's not enough spread for it to make sense for you. But if you're doing like a 100-unit flip and there's like a couple $1 million in upside on the table, then you know that makes sense to check out once a week or every couple weeks. Go to Vegas. I mean, it'll pay for those. I mean, every flight costs money too, and like hotels and everything too. So
write-offs.
Yeah, they're all write-offs, but you got to budget them in your overall. And
Yep. Nice. Okay. So how do you plan to use social media in 2023? I know you're starting to, you said the people in your office kind of look at you as the social media guy, and I know you use it actively. and you know, I've been asked like, oh, well, why do you use social so much? And the awareness, right? For me, it's awareness. If you're not posting, people tend to forget about you. And if they forget about you, how can you do business with them? So for me, it's mainly awareness. But what about you? How do you plan to use it? And
Well, I have a goal for this year to get my own podcast going.
Let's go.
Podcast, man. I'm getting inspired here. You got all the setup.
Thank you. Appreciate it.
But
maybe we just do a collab.
Maybe, I'm sure. You know what? You're probably going to be on mine next week. So
boom. Let's go.
I'm going to have to move to a higher apartment in the next highest building in San Diego.
Good luck.
I think you got me there. But
it's
I think podcasting is great because you can have this long form content and then hire someone like, I'm sorry, I forgot your name again. Brandon, short form king over here.
Short form king.
Come and transition a lot of this into like digestible content for like Instagram. But already just the other day I walked Garrett's project.
Is this in North Park?
The North Park.
We got to get Garrett in here next.
Yeah.
Garrett, this is a call out to you. We'll see you next.
Ask him about his cabinets he's using. They're
expensive?
No, they're more expensive than the ones you or I would pick, but they're sexy, and his projects are probably going to command a little higher rent for that. But you know, long story short, I was watching. I went and visited a project that I sold him on North in University Heights.
Nice.
And he built 2 3-story ADUs. Actually, it's a total of 4 units, but 2 structures.
How many square foot are each ones?
There were like
12.
800 square foot, 2-bedroom, 2 baths, and then like 400 square foot studios or 1-beds.
Nice.
Actually, they were 1-beds down below. He put up a wall. They're small 1-beds, but it's in a killer location. In
you know what North Park kind of reminds me of? With San Diego State, we were buying these homes, right, and building the ADUs. And like doing all this value add, you know, getting our hands dirty, getting the plans. North Park reminds me of that. You can like buy a little 4-unit and add like another 4 units to it.
I mean, you guys are pushing the limit. I mean,
I don't know in North Park yet, but I know Garrett and Matt do, and it's inspiring. You might have to send me a deal out there.
Hey, we could talk about one at the end of the podcast here. But I did follow him around and just say, hey, you know, it's cool. I sold it to him a year and a half ago. Now these units are built and up, and you know, we toured the project. I had my intern, you know, video us, and we were talking about all the pros and cons, the obstacles he had to overcome.
Yep.
And I think that's great, valuable content. I want to do more stuff like that in the field, like, you know, actually at buildings, because so many people, there's this like huge gap, and that's why they rely on people like you or me to like help them buy the house or help them, because I mean, they're doing their tech job during the day. They don't have time to understand like what do I actually have to care about? Like, oh my God, the roof shot, is this gonna cost me $1 million? Yeah. And then you or I are like, no, it's gonna be like 15 grand or 20 grand. You know, like having relative understanding of the costs and things like that, I think, and then also just posting about it shows them that you know what you're doing. Yeah. And gives them the confidence to make that leap of faith with you.
Yeah. That's how I raised most of my money, is I was just posting deals I was walking early on. Yeah. And
and you're still doing it. You're just walking deals.
Yeah. And I'll get one DM. And then, I mean, you know, one DM, a month later turns into, hey, I have 50 grand. Like, can we do a deal? And that's how it starts.
Yeah.
Deal by deal is what I always tell everybody.
Yeah, yeah. And, I always post, on almost all my posts, I post good business only.
You do, and I
Because-
like that. You stand for something.
Right.
Tell us more about that.
Well, I say that because I've been burned so hard by that deal that was down the street that we talked about earlier. But also I see time and time again, there's people in town who don't do good business. Like they'll use their fiduciary, relationship with a seller to their own advantage. For example, I'm representing you. I'm telling you, hey, this is like, let's list your property for $1.4 million, and then I bring in, or there's a couple offers on the table. 2 of them are maybe people I'm representing, and then they end up investigating the property and saying, oh well, everything's messed up. But little does the seller know that you have a relationship with this buyer, and that you might even be owning the property with that buyer after close of escrow. But you're saying to the seller, I got your back because I'm representing you.
Got it. So kind of like a conflict of interest.
There's a total conflict of interest.
Because you're not really getting the seller. Maybe the seller could have got 1.6, but in the seller's mind,
1.4,
or whatever it was,
He
yeah.
ends up selling. You end up bamboozling him into
I
selling
see.
it to you or selling it to your client for $1 million, and then 2 months passed after close of escrow. You have this arrangement with your client behind closed doors. You end up owning that asset within maybe in a 50-50 capacity. I mean, that just doesn't sound like good business.
Yeah.
How could you? The seller's trusting you to have his back, and then you have an obvious conflict of interest when you're getting the deal, and then you go and resell that property for $2 million 6 months later.
Got it.
But I see that happen. In San
Yeah, I was
Diego.
curious about that. I figured that is a thing that happens to sellers. So you see that
It
happen.
happens to sellers, but even on the syndication side, there's a difference between someone who does good business and makes logical, good decisions to do right by their friends and the investors that trust their money with them. And then someone who's just kind of cutthroat and gonna lie and essentially, if I'm telling you I have your back, but I end up stealing the property from you, I'm lying to you.
Yep.
So that's there's a line I won't cross as a broker, and there's a line I recommend anybody doing business doesn't cross.
Yep.
And I think it's a pretty easy line to spot if you just have good intentions.
Yep. Okay.
So that's why I always preach good business only.
Love it.
We have a lot of opportunities to do exactly what I said, but we always take the high road.
Nice.
And I think that goes a long way too, just showing what we're doing and on your end showing what you're doing on projects. Recently I heard that you had a similar situation to that one where you lost a property, but in your situation you actually took the entire hit of
It was my own capital.
what happened with that project. And looking back on that, I said, he took the risks, and then but he also absorbed
Exactly.
the costs. So
No investor lost any money except me on that deal.
By my standards, that was good business.
Yeah.
So
appreciate that.
I
Definitely a learning experience and
Huge
a
learning
costly
experience.
one. But sometimes these little inflection points kind of create something, and that's actually why we're sitting here now. I don't want someone who's listening out there to have to lose money like I did. So if I can teach them how to do it the right way, it'll put them in a better chance in which they're not going to lose money.
Exactly. And I'll just give you a contrast to my scenario. My syndicator, he made a bet and took risks with investor money, and in the end, the investors lost. So in your scenario, you took the risks, but in the end, you lost the money.
Yeah.
But there was a big reward if you were able to make it work. But you
Yeah.
didn't risk money that you didn't have yourself, and no one else got hurt because of it. And it was a big blow to you. But you took it like a champ and treated it like a learning experience. And in the end,
Absolutely.
that's going to go a long way. How would you expect to raise any more money
Yeah.
if someone else took the hit for decisions you made?
Yep.
You took full responsibility, and I think that's admirable. So
Appreciate that. Thank you. Well, I think that pretty much wraps up all the questions I had. I appreciate your time and all the value you dropped with us. And yeah, where can people find you online?
you can find me on Instagram. My name is Cashflow Alexio.
Let's go. That's Cashflow Alexio.
Cashflow Alexio. And then my business partner Adrian and I, we have a website, lionscre.com. It's like Lions plural, commercialrealestate.com, Lions CRE. And you can see some of the listings we sold and testimonials and listings we have available there. You'll see a lot of San Diego State listings, some of them Chris's.
A lot of them.
And then you can reach out. You can find my phone number online or through any of those resources. Happy to give you my take on any deal you're looking at or share with you what we got off market and on the market.
Awesome. Well, thank you, and until next time.
All right. Peace out.
Peace.
Thanks, Chris.